Austin's housing market is on the verge of collapse, and that collapse has already started. I'm seeing potentially 35% price declines across Austin's housing market over the next 2 to 3 years. It's going to get hit harder than pretty much any other market in America. Now, how do I know that? Well, there's two real-time indicators, two real-time data points that I've been tracking and continue to track, which say that number one, Austin is in a massive bubble, potentially the biggest of any in America, and two, that bubble has already started to unravel here in late June 2021. What I'm going to do for you guys in this video is share what those real-time data points are and show you how you can track them yourselves for the markets that you're interested in. What I'm also going to do is explain 5 other cities that share very similar characteristics to Austin that are also on the precipice of a housing collapse. Because it's going to be Austin and these cities that lead the rest of America into the next housing crash in mid to late 2021. This is going to be a great video for you to watch if you're a home buyer or a real estate investor, and if you want to learn more about the factors that influence the housing market and how to predict and time a market bubble and collapse. Without further ado, guys, let's get into the data. So guys, the fundamental driving force of every single housing market isn't actually home prices, it's rental rates. Rental rates are really what drives the future direction of a housing market. Because historically, home prices, they tend to kind of be very up and down. Prices can go through big swings up and then they crash down. Rents do not have that same type of volatility. And what happens historically is that home prices, well, if they go up above rents, they tend to come down closer to rents. If they go below rents, they come back to rents. And the key metric that we look at here is price to rent ratio. It's the ratio of how high home prices are to the typical rental rate in the market. And where I'm going to get started with you guys is analyzing over the last year how Austin and all the other cities in the US compare against home price growth to rental rate growth. Because this is really the key, the bedrock of this analysis for how you can spot a market that's overvalued and set to crash. So what we're looking at on this graph, guys, are two things. One is the home price growth percentage over the last 12 months in these metros across America from May 2020 to May 2021. And then we're looking on the y-axis at the growth in rental rates over the same time period. So the home price growth, that's the typical price of a home in a market and how much it's gone up. The rental rate growth is the typical annual rent that a tenant pays in the market. And we could see that there's a really strong relationship between these two variables, right? So the markets here in the bottom left, like Des Moines and Houston and Minneapolis, and Honolulu and Madison, they have low price growth and they also have low rent growth. If we were to go to the top right of this graph, look at Riverside, California, Spokane, Phoenix, Stockton, Tucson, they have both high price growth and high rent growth. And this makes sense because the demographic factors that would cause one tend to cause the other. However, we have this very unique situation where Austin, this yellow dot here, is all the way by itself on the bottom right of the graph. You can see it's not even remotely close to any of these other metros. And why is that? Well, because Austin has pulled off a very unique situation here where over the last year, home prices in the market have gone up by 31%. 31% appreciation year over year in Austin. That's absolutely ridiculous. No other large markets even close. Phoenix is number 2 at plus 23%. But yet we see that rental rates in Austin have only gone up by 3% in the same time span. So the home price growth is 10 times higher than the rental rate growth over the last year. And that's a really curious situation because we can see almost all these other markets, right? There's a strong relationship between these two. Like we go to Dallas, for instance, home prices have gone up by 14%, rents by 4.4. That's a 3.3 times premium of home prices to rental rates. In Austin, it's a 10 times premium of home prices to rental rate growth. And this is really concerning for Austin's housing market because ultimately the relationship of price growth and rent growth, they want to get close to each other. They want to converge towards each other. A market where prices are going up way faster than rents is not a healthy one. Now, I think a lot of people might say to themselves, hey, Austin's home price appreciation, yeah, it makes sense because, well, after all, there's so many new people and jobs moving to the city that of course home prices go up. The problem with that is that if, for instance, there's so many new people and jobs moving to a city above what the housing supply can support, you would also see rental rates go up. right? And that's the key point, looking at both home price growth and rental rate growth. And we can see that this is actually a long-term trend in Austin. This is not new. Home prices in Austin have been going up faster than rents for several years already, and they've simply ramped into overdrive in the last 12 months. And you can see that exemplified on this graph, where we're looking at the price to rent ratio in Austin, which is the typical home price in the market. For instance, in May 2021, $459,000 divided by the typical annual rent charged to tenants, which is $18,000. So that's 25 times higher, the home price than the annual rent. Compare that to the blue line, which is Phoenix. In Phoenix, it's 19 times. The price to rent ratio is 19 times higher. Home price of $367 divided by typical annual rent of $19,000. If you guys are enjoying the data in this video, please just hit that like button. I spend a lot of time preparing this content. In return, just hit that like button for me. It gets me some more exposure, allows me to actually produce more of these videos going forward. Also, make sure to comment. I want to hear what your experiences are in the housing market or as a potential buyer or renter. When you guys comment, it makes these videos better. All right, guys, let's get back to it. But what we can see is that Austin wasn't always at this significant premium to Phoenix. If we go back all the way to 2014, both markets were right around this like 17x level. You know, back then Austin home prices were $245,000 typically, rent was $14,000 typically. But ever since then, this yellow line in Austin has just kind of started ascending above what the blue line Phoenix is doing. And what that means is prices are going up faster than rents in Austin, whereas rents are keeping up with prices in Phoenix. And I think this comparison is very interesting because Austin and Phoenix share a lot of similarities in terms of demographics and growth. They're both huge growth markets with lots of jobs, lots of migration, lots of beneficial things going on in these markets. But we see two very different stories about how prices and rents are behaving. And the thing I want you to pay attention to is that in Austin, price to rent ratio has gone from 17.3 to 25, basically +8. Over the last 6 or 7 years. In Phoenix, it's around +2, 17 to 19. Remember that. Austin at +8, Phoenix at +2. And the more that these prices in Austin stretch above what the rental rate levels are in the economy, the more a couple things will happen, right? If you're someone looking to buy a home in Austin you haven't bought yet, well, with the price is surging, you're going to get priced out. And with the rent staying relatively flat, you're going to say, okay, it's not hard for me to just rent for another year or two. Conversely, if you're an existing homeowner in Austin, you could potentially sell your property at a peak price and become a renter. I've actually met a lot of people. I live in Austin, by the way. I've met a lot of people over the last 3 months who have done that. The other thing that's going to happen is investor owners are going to start selling their properties because Austin's a very low yield market to begin with. You don't get a lot of cash flow for the price you pay. If investor owners are seeing this crazy appreciation, yet their cash flows aren't going up that much, they're also going to be induced to sell. And all of that's going to cause huge increases in the amount of inventory on the market, which is something that we're already seeing in Austin. And that's something I'm going to talk about a little bit more later in this video. There's already been massive surges of homes on the market, inventory on the market in Austin. But I want to actually show you guys the proof of this concept, that price to rent ratio and increases in price to rent ratio are very predictive of housing declines. Because I think the theory might make sense, but when you see the proof in the data, that's when it really makes sense. So let's go back to the last housing crash. What happened in the last housing crash? Because certain markets, got crushed, destroyed, 50, 60% declines in value. I personally don't think that's going to happen in any markets this time around, but some markets got really destroyed last time. Other markets actually increased their home prices during the last housing crash, believe it or not. So it was a very unique situation during the last crash. Some markets didn't really feel anything. Others got utterly destroyed, and investors and homeowners lost everything. What was the key differential between those markets? Well, guys, it was the price to rent ratio, and it was specifically how much the price to rent ratio increased before the crash. And you can see what I'm talking about on this graph where we're looking at two things. Here on the x-axis, we have the change or the increase in price to rent ratio from 01 to 06. 01 to 06, that was the lead up to the last housing bubble. That was actually the only other time in U.S. history where prices have increased as much as they have from 2016 to 2021. 01 to 06, that was the only other time where we've seen this kind of rampant appreciation. And then we're seeing here on the y-axis the percentage decline in home prices that occurred from 07 to 2012 as the bubble burst. What's really evident, what's abundantly evident, is the strong relationship between the two. The more that price to rent ratio increased, aka the more that prices went up more than rents prior to the last crash, the more that prices then came crashing down once the crash commenced. And let's actually take a look at Phoenix. In 01, Phoenix had a 13.7 price to rent ratio. In 06, that price to rent ratio went up to 23.8. It went up by a factor of plus 10. What then happened over the next 5 years? Prices in Phoenix declined by 54%. Interestingly, Phoenix is in a very different situation now. We just talked about how its price to rent ratio in recent years has only gone up by plus 2. So Phoenix is an example of what can happen when home prices go up way more than rents. However, nowadays it looks very different. Let's compare that to a market like actually Austin back in the day. Austin really dodged the last housing crash. Prices only went down by 4%. Why did it dodge the last housing crash? Well, the price to rent ratio in 01 was 14. It went up to 15.3, only an increase of 1.2. Since there was such a small marginal increase in price to rent ratio, that means the fundamentals of the market were solid and prices didn't decline by much. Now, interestingly, today Austin's in a completely different position. Price to rent ratio in the last 5 years has surged by plus 8. Let's take a look at plus 8. What did plus 8 do in the last crash? We see Miami was around plus 8, values declined by 52%. Seattle was around plus 8, values declined by 33%. Portland was plus 8, values declined by 27%. Jacksonville was plus 6.6, values declined by 40%. So if you were plus 8 in price to rent ratio in the last housing crash, you got crushed. You got crushed. And that has a huge implication and concern for where Austin's going to be going in the next couple of years. So I'm just going to repeat this, guys. Bear with me. I want to make sure everyone understands this. There's a lot of data flowing in your direction here. From 2001 to 06, the markets that had the highest increase in price to rent ratio, the ones where prices went up by more than rents, those were the ones that had the biggest housing bust from 07 to 2012. So it was increases in price to rent ratio, which was extremely predictive of how much values went down. Interestingly, Phoenix and Austin back then were completely opposite positions from where they are today. Back then, Phoenix was the bubble market with huge increases in price to rent, and Austin was kind of the stable market with low increases. Today, it's flipped. Austin is the bubble market, and Phoenix is more of the stable market. And why I love this price to rent metric so much and the increase in price to rent is it adjusts for all the things, all the factors that people typically try to use to explain the appreciation. Again, we go back to a lot of people say, oh, there's so much migration into Austin. Okay, well, yeah. Well, that should show up in the rents. If it's not showing up in the rents, there's something systematically flawed in how the housing market is behaving. Other people like to talk about inflation because we are seeing inflationary pressures in the US. The great thing about price to rent ratio is it accounts for that because if there is true inflation going on, we're going to see rents increase, right? So this price to rent ratio is such a valuable data point because it factors in migration, housing shortage, inflation. It tracks all of that together and really shows you the fundamental relationship and how healthy a housing market is. Now, guys, the great thing about this data is you can track it yourself very easily for the market that you are in. You can go to Zillow, go to the links in the description. They have an amazing database of information on prices and rents. You can download them into Excel spreadsheets, and you can compare in your market how much prices are going up relative to rents. And that's going to be a key indicator for you about whether now is the right time to buy or the right time to sell. But in case you guys don't want to do all that work yourself, I'm going to show you some other markets that you need to be concerned about in terms of how much price to rent ratio is going up, because Austin is not the only one. There's really some other markets where I'm calling big bubbles, guys, and these bubbles are going to burst very soon. So what we're looking at on this graph are the top 10 markets in terms of increases in price to rent ratio over the last 5 years. And number one, what do we have at number one? We have San Jose, California. Price to rent ratio went from what was an absurd 29x in 2016 all the way up to 40x through May 2021. San Francisco, right there along with it, an increase of 10x in price to rent ratio. Again, remember, an increase of 10x, that was about what Phoenix had in the last housing crash when Phoenix declined by 50%. Some other markets with high price to rent surges: Seattle, we already talked about Austin, Boise, Salt Lake City, Provo, Utah, Ogden, Utah, Denver, and Boston. These are the markets, guys, where I am most concerned about bubbles bursting. And if you've watched my channel, you're not going to actually be surprised by these cities. I've talked a lot about Boise. I've talked a lot about Salt Lake and Seattle. These markets are squarely in the crosshairs of the impending housing crash. As we can see, not every city has had this runaway increase in prices relative to rents. The average market has seen about plus 2.6, which is a much more reasonable increase. If we go all the way to the other end, we can see that in places like Riverside, California, price to rent ratio is actually barely increased, which means that the fundamentals of rental rates in Riverside are still supporting the home prices. Virginia Beach is another. Rochester is another. Columbia, South Carolina. Scranton, Pennsylvania. These markets down here are going to be much more secure in the next housing crash because the underlying rental fundamentals are supporting prices at a much firmer level. Now, one thing you might have noticed about those markets that were at the top of the price to rental surger list is that they shared some interesting similarities. They were either in California, we had the two Bay Area markets, San Fran and San Jose, or there were cities and markets that were kind of tangential to California in some way. Seattle, Austin, Boise, Salt Lake, Denver. These are all markets that experience a lot of California migration. A lot of people from California move to those cities, and all these cities also have a fairly big tech presence. So I don't think it's an accident that they're all looking pretty similar in terms of how much these markets are in bubbles. And I think all of them are going to basically lead the crash. Austin's going to be first, and then the other ones like Salt Lake and Boise are going to follow closely thereafter. And these are going to be the cities in America that are going to A, decline the most, and B, decline first. So you're going to actually also want to be watching, even if you're not in these markets, you're going to want to watch what's happening in these markets. But once you see the price declines happening here, they're going to start to occur in other parts of the country. Now, so far, we've only really talked about how big the bubble is, right, based on price to rent ratio and like what we can expect in terms of potential price declines. Like I said, I'm seeing 35% in Austin. I'm seeing 35% in Boise. I think the Bay Area has a 25 to 30% correction in it. Big corrections and crashes in those markets. But the other question is timing, right? When is this going to happen? Because I think a lot of people can just call a bubble endlessly, right? But you got to put some time frame on it. And so what I'm using to do that is I'm looking at the inventory in these markets. How many homes are listed for sale actively? And how are the count and the percentage of those homes changing over time? And what we're seeing in a place like Austin is a massive increase in home listings on the market over the last 4 or 5 months. Amazingly, this is not something anyone is reporting about or talking about in the media, probably because it doesn't fit the narrative of home prices going up forever. But Austin is seeing a massive surge in inventory and listings over the last 4 months. And a massive surge in inventory, that's the first thing you need to see. That's the first stage before you see price declines. And you can see, guys, what I'm talking about on this graph, where Austin has seen a 78% increase in the amount of active listings on the market from late January to late May. And this is data that, again, comes from Zillow. I'm going to have a link to this in the description. You guys can look up this data for yourself for your market. So Austin's had a 78% increase in listings over the last 4 months. You could see that no other city is like even in the same stratosphere as Austin in terms of inventory surge. And that inventory surge, guys, let me tell you, we're only tracking data through late May here. Zillow has a lag on reporting it. I live in Austin. I talk to a lot of realtors. I talk to a lot of people in the city. If this data were updated from late June, expect to see this at like 100% increase or 120% increase. Because even in the last 2 weeks, there's been an even bigger surge in inventory going on. So Austin, at this point, the inventory levels are already back to what they were pre-COVID. They're back to what they were pre-COVID with prices 30% higher and a huge deluge of new building on the way that's going to get delivered over the next year. That's a nasty combination. What are some other markets with big increases in listings? Colorado Springs, Boise, Salt Lake City, Provo, Seattle, Madison, Ogden, Utah, San Jose. Wait a minute, guys. What do we notice about these cities? These names are very familiar. Oh, right. They were actually on the price to rent ratio surger list. It's all the same cities. It's Seattle, Austin, Boise, Salt Lake, Provo. These are the ones that have actually had the biggest increase in listings in the last 4 months, which is a sign, again, of the relevance of this data point and a sign that these markets are so overpriced right now and they're already starting to see softening. So yeah, that's no coincidence that it's the same cities that had the price to rent surges. They're the same cities that have the biggest increase in inventory, guys. That is not a coincidence, and it's going to continue to happen. Expect to see inventory continue to surge in Austin, Boise, Salt Lake, Seattle, San Jose. These markets are going to become very soft very, very soon, much more favorable for buyers over the next year. Guys, it's just so important that you use data right now if you're insisting on buying real estate in mid-2021. Because prices have never been higher compared to inflation, compared to wages, compared to rents, compared to building costs. 2021 prices are near an all-time high. The only other time that the market behaved like this, the only other time in U.S. history where this has happened is 05-06. And we all know what happened after that. A lot of people try to say, oh, it's not going to happen again because we don't have subprime loans, or because all the millennials are going to buy homes, or there's a massive shortage. Most of those arguments are crap. Prices have gone up a lot. The only other time in U.S. history where they went up by this much, they had a steep decline, and we know the metric price to rent ratio, which predicted that decline. So use data, guys. Make informed decisions. I'm going to have links in the description to the Zillow data so you can look it up for yourself. If you guys are enjoying this channel, or you're new to this channel and you haven't subscribed yet, just make sure to hit that subscribe button. I have 2 to 3 of these data-driven videos coming out per week. Each Wednesday, I actually do a market deep dive where I go to a new city around the U.S. and dig into the data on that city specifically. Last Wednesday was Tampa. Next Wednesday, it's going to be Orlando. You're not going to want to miss this content going forward, so make sure to subscribe. Also, make sure to comment. I want to hear what your experiences are in the real estate market, whether you're a buyer or renter. When you guys comment, it makes me more informed. It makes these videos better. All right, guys, until next Wednesday when we cover Orlando, this is Nick from Reventure Consulting signing off.